So this is it. I guess you asked about US 30's price action for last week, where we had uh, US 30 giving us a trend line pattern for price to actually take out liquidity and go into demand. So according to what we can see, we discovered that price decided to not go as low as we expected because it came into this demand. It came into this demand here, and then we had price come in, and then from there began to move. So you can see that all of the trend line, it came down to this level down here, and from there we can see that price began to move up. So it began to move up from then onward. So this place was holding demand for price to move. So it was holding demand for price to move. And so price was moving from here and it went up there. So that is what we have. So initially, we were thinking that price will come down into this area and pick up. It might eventually come there some later time, but then we already have this demand mitigated. And when it touched into this demand, it reversed back immediately. So that means there was a lot of volume on that particular in that particular area. And so we have price having tapped here, went up this way, and then went up like this, swept this liquidity and then tapped in here. And now we already have another setup forming because why? We have this high here that failed to break structure to the downside because this was the low that was formed from this high because this high failed to break structure. And so we should expect that this high will be taken out, and that is why, having tapped demand here, we should expect another demand to follow from there, and then we can continue to go down, to go up to take out this high. And so that is what we have. In this particular case, that is what we have. All right, so we see that, and then from there, we have price reacts to this. Where price reacted there. And so for BTC is a different matter altogether. See that price has been moving from demand to demand. We had all of this demand here. Price moved from here, swept all of this liquidity, and then price tapped into demand in here. And so we have price having moved from there. Price is now moving from inside of this demand that was here to go here and then probably to go take out this high. So that is what we have. So we also discussed risk management. So we discussed risk management. And for risk management is understanding how to manage your risk whenever you are trading. And how does it go? Risk management is being able to understand that you should be able to understand the amount of money that you put in a trade in the market. Okay? So the amount of money that you are willing to lose in a trade in the market, that is what risk management is all about. Just to understand your risk. So for understanding risk, it is important that you risk only a certain percentage. So maybe like for a $1,000 account, let's say it's a $1,000 account that you have. So for that one, you might want to risk how much is that? This is your capital. This is your capital. So you might want to risk 1% per trade. I want to risk 1% per trade. 1 to 2%, yeah. 2%. So 1 to 2% risk. 1 to 2% risk will be $10. 10 or $20. 10 or $20. So this is just the idea. This is the idea behind risk management. This is the idea behind risk management. So you are able to risk a certain amount of money, and after risking that amount of money, you know how much you are going to risk to get a reward. So it's risk to reward that we use for calculating what we are going to gain and how much we are going to risk. And it is always pertinent that you understand that you are losing so amount of money if at all this trade goes against you. Because the reward sometimes might seem appealing, but it is not the best actually. So it's not the best. It's better to focus on how much you are risking than how much you are going to lose. Because if you are at peace with the amount you are going to lose, then you don't have any problem with if price goes against you. So that's just it. So for a capital like this and a risk like this, we should expect a reward of should expect a reward of $20 for a 1:2 trade, and a reward of $30 for a 1:3. So that is the way it is. So a 1:3 RR, you should expect this amount of risk to reward, and for a 1:2, you should expect this. So for $100 too, in the same way, if you have $100 and you want to take a trade, you are risking 0.1. Sorry, for $100 you are risking 1. Sorry, you are risking $1 to $2, depending on your percentage appetite. So you are making a profit of $2 here. I am making a profit of $3 here. So you are risking $1 to gain $3, or risking $2 to gain $6. So that is the concept of risk to reward. You just calculate your risk and you calculate your reward. So just like here, let's say for US 30 now, we went and like this trade we are placing here. Okay. Now this trade we placed here, our objective is here, and this is where our entry is going to be. So for this trade now, we have 5.56 RR. So that means that in this case, if you are risking $1, okay, if you are risking $1, then we are expecting to gain at least $5.56. So that's the way risk to reward and risk management is. To be able to understand that this is how much I'm risking and this is how much I'll be gaining. So better to just focus on how much you are risking so that you can be able to minimize losing your account. So that's just the understanding behind it. So that is it. That is practically everything to know about risk management and risk to reward. So the video I sent will provide enough justification concerning that topic.